Good afternoon, everyone. This is Kim Schmidt. I'm the executive editor of Farm Equipment Magazine. Welcome to our latest webinar, What's Your Valuation Strategy in Today's Market, in conjunction with Pinion. Today's presenters are Mark Johnson, who proactively counsels business owners on financial and tax matters in order to position them well for growth and business succession. And he works primarily with equipment dealerships throughout the United States and has for over 20 years. And Ryan Herman, who creates forward-thinking estate and business plans for family businesses, especially those in the equipment dealer industry. Thanks again for joining us, and take it away, Mark and Ryan.
Very good. Thanks, Kim. It's always a pleasure to give these webinars and talk to some dealers out there that we might not otherwise get in front of. Actually, Ryan and I are just finishing up a meeting with a dealer here in the Midwest, and we went through many of the things that we're going to go through in this webinar today, especially for their dealership. Looking at year end and how things are going right now and how that relates to the valuation and what that looks like for their succession planning and estate planning and all that kind of stuff. So that's some of the stuff that we'll hit today. With that in mind, I want to just give you a quick background about Pinion in case you don't know. If you knew us a really long time ago, we were Keiko Isom. We changed our name about 2 years ago now, and we're Pinion. We primarily have customers in the ag markets across the country. About half of those or better are actually producers, same customers that you guys have. And then the rest of them are ag dealerships and seed dealers and other agribusinesses all over the country. So the good news and the bad news of that is that we are very familiar with your customer base and the industry you're in. The bad news is we're going through some of the same rocky times that you guys are going through right now. Our customers are experiencing the downs right now, I guess, of the commodity markets and things like that. And it's just really hard for them to make a lot of decisions when it comes to buying equipment or purchasing professional services from folks like us. So anyway, I just want to give a quick, brief update about who we are in case you hadn't heard of us before. And then, why is today's topic? Why did we pick it? Well, first off, we pick a lot of different topics throughout the year. I know that a lot of you right now are probably focused on how this year is going, and this year is not going as well as the last several years have gone for many of our dealers, and we certainly are hearing that. But that doesn't mean that we don't still plan for the future, right? In fact, years like this, when things are down, is when we actually can kind of catch our breath a little bit and say, okay, what could we do different, or what should we be different? So for the next time that the market picks back up, we'll be well positioned to take advantage of that. So what has happened in the last several years that has made valuation anything different? Well, actually a whole lot of stuff. It started with there was a big tax act in 2018. There was a different president in power, and he may or may not be running for president again right now. So we had the 2008 Tax Act, and the big changes that did to valuations was twofold. One, it raised the estate tax limits for, and I'll assume a married couple for a second. It used to be about $13 million is when we started having that married couple pay tax if they had both deceased. And now that number is about $28 million, depending on the inflation you look at. That expires soon. In fact, it expires at the end of 2025. But in the meantime, a lot of dealerships were given away from 2018 to now because the dealer principals and owners took advantage of the fact that the estate tax limits were higher. And because the estate tax limits were higher, our dealers might not have been as aggressive as they might have otherwise been of trying to beat down the value of their dealership because they had plenty of room to give up in a lot of cases to slide in underneath that $25 million. So that Tax Act alone changed values, right? Similarly, not as much for the ag dealers on the call, but for the construction dealers, particularly if you're an ag dealer with a rental fleet, we had the end of like-kind exchange, at least the end of like-kind exchange for everything but land at 2018. So it used to be if you had a rental fleet, you could kind of trade that rental fleet in every year, take a big tax depreciation number, and kind of move on. Well, the tax depreciation number kind of lost its way on that because like-kind exchange didn't work anymore. And so now all of a sudden we were paying taxes on rental fleet turnover. So that slowed down how much rental fleet we had, and rental kind of slowed a little bit in the last few years because of that. And because our asset base changed from having a bunch of rental stuff on the books dealership values followed. Then, we went through that period of time from 2013 to 2018 or so, wondering when we were going to recover from the downturn of 2013. And in 2019, we did. Our dealers started showing great profits, and we were very happy with 2019 profits. And of course, that made our dealership values increase as well. And then March of 2020 happened. And as much as we're all tired of talking about COVID happened, right? And so since March of 2020, which what started in 2019, just took off exponentially. And our dealers had record profits year after year after year after year. I don't remember if I got enough years in there, but year after year until we get to this year, right? Actually, specifically until we got to June of 2023. One of the reasons that we had increased profits through those years and increased sales through those years because the interest rate went to zero because of the COVID impact, and it stayed at zero until June of 23. And guess what? June of 23, they raised the interest rates pretty high, and you guys have been suffering since then. Not only you guys, but also corn prices and all kinds of stuff. So it's been a tsunami of stuff that could go wrong in the dealership world. Did go wrong. Corn prices went from $6 and $7 down to underneath $4, and interest rates went from 0 to 8 and 9% for your customers. And talk about something that can shut down growth. That's exactly what happened. And if growth got shut down, what happens? Your valuation numbers change. Inflation also happened during that time, right? So depending on the manufacturer that you sell for, we had several price increases along the way. There wasn't a manufacturer that didn't raise prices, and there wasn't an employee that didn't ask for a raise. And so we had to raise prices to make sure we were meeting some of those expenses. But because of all that, stuff got out of whack. Our sales mixes changed because we used to sell 60% of our revenue, 70% of our revenue used to be in the whole goods market. Now it's up to 80% of our revenue is whole goods because the price got so big and we were selling so much. And so all that kind of changed our forecasting and understanding what the market was going to look like for each dealer going forward. Now we get to 2024. We have an election coming up here in just a few, less than 2 weeks now, I think. Am I got that right?
Yep.
Less than 2 weeks. It's a little scary. As much as we love to see an election over, when it gets down to the end here, you start to get a little willy about what's going to happen. Is my person going to win, or is my person going to lose, and that kind of thing. One thing we do know is during an election year, we don't know anything, right? We have a bunch of unknowns about this person could like this for taxes, and this person could like this for regulation, and we have all this back and forth that frankly none of it really matters all that much if Congress doesn't agree with them anyway. But we get ourselves all worked up into what does the future hold, and more importantly, our customers get in the same spot. They don't know what's going to happen in the future, and they tend to slow their buying down. And then the other thing that's happened, specifically in the equipment dealership world, but really in all industries, is mergers and acquisitions and consolidations have happened. Even in our world, in the accounting world, mergers and acquisitions have been going gangbusters, and private equity has entered the market, and they're buying accounting firms. We never thought that would happen, but we used to never think private equity and family offices would never enter the equipment dealership world either, but they did, and they entered it pretty aggressively. And every time they got in with their millions and billions of dollars, the valuations tended to increase in those dealerships because most dealerships were selling a portion of their business and not at all of their business. And they were selling it for pretty high multiples because we were looking at record growth for 3 and 4 years in a row. So that M&A market really kind of boosted the price of a dealership, and valuations, all that kind of stuff changed to the point where we got dealerships now that are bigger than we ever guessed they would look at. I was talking to some guys the other day that, as I was looking back, in the 2016, 2017 area, less than 10 years ago data, and there was only a couple of dealers in the ag side that would have been over $1 billion in revenue. And now there are, across brands, there's probably 15 or better dealers that are over that $1 billion in revenue now. And so that the market that consolidation has just really made the size of dealers grow. So with that said, what does all that have to do with what we're going to talk about today? Well, the valuation strategies for your dealership have changed. So some of the things I want you to understand as we take away from today is there are essentially three different reasons we would value a dealership. Probably more than that, but there's three big ones. We value it because we're selling it. We value it because we're doing some succession planning, or we're valuing it because we need Uncle Sam to buy off on our estate tax planning strategies. And those are the reasons that we do that. And those three different valuations can produce very different results. And we're going to go through some of why the reason is. And the reason is because we use three different methods to do that. We want to talk about why is it important for you to understand your valuation every year. A lot of our dealers in the past would have every once in a while, when they had a transaction or when they had an estate tax plan change come up, that's when they did evaluation. That was the only time they did evaluation. And we'll talk a little bit about why we think this ought to become an annual exercise for you. Not so that you spend more fees with somebody like us, because a lot of times the valuation that we're asking you to do might not be performed by us. We might ask you to have that performed by somebody else. We just think it's a good practice, and we'll go through why that is. And then we want to understand the impact on how we can actually not just improve profitability, but improve our valuations or the long-term returns that we can get for our shareholders. And in doing so, is there a different way we can look at KPIs or key performance indicators in the way they interact with valuations? So I got a couple of funny quotes up there. Hopefully you've already seen some of them. Yogi Berra is one of my favorite people, and a nickel ain't worth a dime anymore. Just had to work that into somewhere. But even Warren Buffett, you think of a guy that buys and sells businesses all the time, and he has the reminder there that there's a lot more to valuing a business than just the accounting transactions. In fact, we got to start with good accounting, and from there we can build valuations. And then Louis Pasteur, who if it wasn't for him, we couldn't drink milk anymore, right? But changes were all over the place during his period, and his point was change affects us a whole lot less, or it favors us a whole lot more if we're prepared for it. And how do we get prepared for a market like today? We kind of understand who we are and what we're worth. So that's the key there. So Ryan, with that, I alluded to this earlier. There's three reasons why we have a valuation. There's more than that, but those are kind of the three big ones for valuations. So with that, there's kind of three different buyers or three different levels of value, and kind of different valuation methodologies. So I'll kind of yield the floor to you for a minute, which is something I have a hard time doing sometime on webinars, letting go of the microphone, but I'll let you take it from here.
Oh, perfect. Yeah, you may see us kind of looking back and forth. We're actually sitting in the same room. Again, we were working the same dealer this morning and over the last couple of days. But so when people look at the different levels of value, one of the main things is to look at is what's the purpose of that valuation. Mark kind of talked about it before. If it's we're actually going to sell this business, we're at a very top of the line value where it is fair market value. What is somebody going to be paying for this? And the estate value is going to get the complete opposite end. We want that thing as low as possible. We don't want to use up as much for state exemption as we can. And so the biggest one is to understand the purpose. I've been in quite a few meetings, and we're doing it for the estate value. And they're like, well, I can sell my dealership for way more than that. Well, of course you can, because that's not the purpose of this particular valuation. But when we're actually looking at more of kind of that buy-sell value, there are three different levels here. And one of them is the hypothetical buyer. It's a very large pool of buyers. It's more of what is that fair rate of exchange? But it's going to be a much lower value on that standpoint. That financial buyer, we're seeing more and more of this. A private equity group. Smaller limited buyers, they're really looking for a return. They're looking for specific aspects of the business. And so that pool tends to shrink when you're looking at a financial buyer. That top level is more of a strategic buyer. Maybe somebody, your next door neighbor, maybe somebody that's going to touch your AR. Again, a much smaller group, but also much higher value on that one, because they're going to be looking at things of, economies of scale. Maybe they're going to be able to increase their market share, and, maybe large ag or some things like that. And so it is a much smaller pool on that one. And so when we look at value, which pieces of these are we trying to, value our company at? If it's a buy sell, we don't necessarily want to put it as a strategic buyer because the return is not going to be there. We don't want to buy somebody out at the very top of the market if that's what we're looking at there. But normally sticking that kind of that hypothetical buyer when we're looking at it, especially from a buy sell. But again, if we're looking at a state, we'll look at some things here, but an even lower value there. And again, one of the things kind of Mark alluded to, everybody wants to, again, the 4 quadrants here, look at it more on the voluntary, where we're looking at hey, I'm going to sell my business. I'm going to get out. I'm going to buy out my partner. Maybe I am, going to give some of my stock. The things that we don't look out for, we still need evaluation for. One is unplanned retirements. We actually just had in the meeting today, one of the owners goes, actually, I'm going to retire at the end of this next year. Okay, if we're not planning for that, we don't know what our value is. Now
we were planned for that one.
This
but
one
no,
we were
no,
planned
yeah,
for.
so it was okay.
But that's a strong buy sell. We can plan for that. But again, there's things that's outside of our control. The big things: death, divorce, involuntary. And if we don't know our value, that's where we get into a lot of trouble. The value of a business is inherently emotional. You guys are pouring your blood, sweat, and tears into your business. And so if we're going through one of these involuntary transfers and trying to determine value, it's essentially a lose-lose situation. But again, if we're proactive and we're actually doing this valuation on an annual basis, the things like a merger and acquisition comes up. Okay, we know our value. We know how we're going to be positioned going into this. If we do got to buy out a partner, okay, our buy sell says this. We know it's coming. We know what the value is. We don't have to negotiate that kind of on the fly. And that's where lawyers get brought in. You're going to spend millions of dollars in fees just trying to figure this out if we're not well planned.
Right. One of the things you talked about was the buy-sell agreement. And, there are a lot of buy-sell agreements out there that allude to value. In fact, if I rewind the clock, 15 years or so, it was pretty standard for a buy-sell agreement to use the language that basically said, we will set the value. The board of directors and the shareholders will agree to a value at their annual meeting. We'll take the audited financial statements and we'll agree to a value at that annual meeting. And then that value will stick until we change it again, theoretically next year. And I don't know how many times I pulled up a buy-sell agreement that they didn't document that they met and did that every year. They might have done that every couple of 3 years, but they're lucky. And I've never actually ran into the situation where we had to undo one of these, but I'm sure it's happened somewhere in the country that somebody died or somebody got divorced or somebody said, hey, I'm quitting and I want to leave. And they went to look at the buy-sell agreement and see that they hadn't changed the value in 4 or 5 years. The value says, hey, we're worth $1 million, even though the book value of the company might be worth $5 or $6 million at that point. And everybody got messed up because they didn't agree. And so valuation is more than just saying we're going to agree to a value every year. It needs to cover the fact that if we got an agreement that says that, we're at least going to document a new value every year. And maybe every year isn't enough. Sometimes something happens during the year. So for instance, somebody might die during the year and we got to buy their estate out. Well, all of a sudden the top line of our company might be the same. We got a big debt on there. We got to buy a shareholder out, and that's not factored in. And then the second shareholder dies and we don't have that recorded. And all of a sudden we got a value that doesn't mean anything. So we really need to constantly update values and not just allude to them in buy-sell agreements.
And you say that, and actually we did run into one. It turned out to be a decent story, but the last value was actually probably 40 years ago, and it was $700 a share. And then we had a partner go, hey, I want to be bought out. Buy-sell would say it's $700 a share. Well, it turned out it was $17,000 per share is what it actually ended up being.
Gosh.
But again, that one was more of a mutual understanding, but had something happen to that person, then it becomes very, very contentious at that point. But again, that turned out to where it was still mutually beneficial. But had they not actually been doing that annually, could have been a completely different story.
Right. With that said, one of the things that the last slide alluded to was there's also a difference, not just in the sale, but sometimes you don't sell the whole company, right? So it's one thing to understand the value of the whole company. It's another thing to understand a piece of the company. So oftentimes we talk about when we're going through valuations, whether we're going through the formal ones to give to the government, which those talk a lot about this, or whether we're talking about the ones where we're selling maybe through a buy-sell agreement or through a merger and acquisition, we're talking about a piece of that. So Ryan, what you might talk about, when we talk about discounts, what are we talking about in layman's terms there?
Yeah, so kind of going top line, we do come up to a value. Normally it is closer to fair market value in terms of, what you sell for a company, things like that. But then, a lot of times we have, not every single company, there's a, greater than 50% owner. example today, most of the owners, own probably 20% or less. And so, that particular person can't make really any decisions.
Everybody's a minority.
If everybody's a minority, really can't, one person can't control the company, elect their own board of directors. And so that first discount is lack of control. So if I sell my shares, that person can't come in and really make any major decisions. So normally we have a discount on that for that minority control. And then the second piece there, that discount on lack of marketability. Unless it's published there on the, in the market, like Apple, there's a stated price. There's no discount for lack of marketability. I can go sell that tomorrow, no problem. For your dealership, though, it's a process. You got to go find buyers, bring them to the table,
get manufacturer approval.
Yep, you have to go through a whole long process in order to make that your shares actually in the liquidation process. And so there's another discount there for lack of marketability. And the discount, the percentage wise, can vary. Some estate side, we're really trying to beat up the value, can get into that 40% range. Buy sales maybe a little bit less, but normally there needs to be a discount for, I'm not selling the full part of my business. This is only a portion of it. There should be a discount on the price.
I know one of the things that, when we talk about in our firm, for instance, when we talk about the three different versions of valuation, there's actually three different places in our firm that we actually would pull those. So if a dealer said, hey, I need a valuation and it's for estate tax purposes, we actually have our certified valuation professionals do that. So Ryan and I are CPAs. We're not CVAs. And so the government's specifically looking for those credentials. And so we will have that done by our valuation department. One of the things that they get into in arguments with the customers on that one all the time is, well, I heard, or my neighbor got a 45% discount when they did their estate plan or when they did their gifting. So I get a 45% discount too, right? And the answer is no. The discount is dependent on the transaction at hand and the company and the management structure and all that that goes with that particular company. When we're doing evaluation and we might not know who the buyer is, like a dealer says, you know what, I think I'm done. And no one has expressed any interest to me yet, or a bunch of people have expressed interest to me, and I just don't know how to narrow that down. In that case, we actually go to our strategic advisory group in our firm that they buy and sell businesses across the country, not necessarily just dealerships, but businesses all across the country. We help them, of course, because we have the dealership knowledge, but they might put out a bulletin that said, hey, that's when they come up with the funky code words and everything. It says, I've got Project Moose that I'm selling this dealership in the Northwest or whatever, and they look like this, and here's we're accepting offers, and then that's a different evaluation strategy. When we know the both parties. So, for instance, it might be a equipment dealer and their neighbor equipment dealer merging together. One might be buying the other out, or that kind of thing. Then that's when our dealership group kind of just handles that one, because that's dealer on dealer, and we know what those values look like, and we help them. And so that's kind of it plays out with different people, plays out with different strategies, and we come up to different numbers. I think the worst story and the best story I had was it was one of the first private equity transactions in the country, and it started out much different than that when I was helping them, and it was going to be a merger of some dealerships, and so we came through and we did the merger version of a value, which meant no one was selling anything. Everybody was going to own at the end. They were just going to own parts of the different dealerships. And we came up with the merger value. And lo and behold, somebody got a phone call from a private equity company during that. And the private equity company said, how much are you worth? And one of the dealers gave up our number, and then called me later to say, hey, I think a private equity company wants to buy us that number. I was like, why did you give them that number? That was not this. That was the strategic value. That wasn't the value that we would have given, an investor. So luckily that was an investor that understood that he was getting too good of a deal. And so we were able to pull that back. But that's just an example of how different those values can look like. So specifically, when we look at the approaches, there's kind of three different approaches when we value a company. One would be that asset-based model, one would be an income-based model, and one would be a market-based approach. So let's go to the end one, a market-based approach. That's the one, if we could do that every time, it'd be easy to do it. But when a dealer sells out, he doesn't publicize to the whole world, hey, by the way, I sold for, here's exactly what my balance sheet looked like, and here's what I got. A lot of times what they might publicize is to their neighbors that, oh yeah, I got 4.5 times earnings, or I got 3.5 EBITDA, or I got 150% cash flow. What they don't tell you is the other details that went behind that. So when people call me and say, hey, Mark, I'm thinking about selling my dealership. What's it worth? And they want that 5-minute answer. What they're looking for usually is that EBITDA multiple. And I always tell them, I can give you kind of a general idea what that's looking like, but that never tells the whole story, because it doesn't tell us what did we do with employment contracts? What did we do with the fixed assets? What did we do with liabilities? Did we have any liabilities after the deal, or were everything paid off ahead of the deal? So that EBITDA multiple means something, but it doesn't mean much unless you know the whole answer. And by the way, that EBITDA multiple in a year like this goes up sometimes, not down like you would expect. And why is that? Because profit went down. So we kind of have a general idea what that value was going to look like, and our profit is kind of beat up this year. So that EBITDA multiple might actually go up in a down year and down in an up year, because if the earnings are so high, then the multiple comes down. So it's really hard to, when you hear somebody bragging about their EBITDA multiple that they got, that might not be the EBITDA multiple that you would get.
So stay on that. The EBITDA multiples, that's normally the questions we get to, is what's the multiple applied to in your EBITDA? And that's my value. Normally that's actually the end result is what the EBITDA multiple is based on the two approaches above, because we're putting in all these factors, then do get to an EBITDA multiple. Yep. Not starting with EBITDA multiple and then kind of coming back from there. And so that's just a little bit of different approach that, again, I normally see throughout here is that people are trying to get to the very end to start. When it's actually the reverse of that.
The easiest method on here, and usually the lowest valued one, is the one on the top, the asset-based approach. And a lot of times that would be a book value type approach, or a liquidation value. And that might be an agreement between shareholders. And a lot of buy-sell agreements do still trade on book value. I don't know why, because book value is usually pretty beat up the way we depreciate things these days. But book value would be simply, what does my net equity on my books look like? And then we might take a multiple of that or something like that, but that's an easy one, not used very often other than maybe in a buy-sell agreement. The far more common, especially what's happening in a new owner coming in, would be this income-based approach. And even it's not really income-based, it's more cash flow-based. We call it income because we convert income into cash flow, but we really want to know, what is the free cash flow of the business going to look like in the future? And free cash flow is basically defined in a dealership world by saying, I start with income. How much income am I going to generate? Then I got the timing of my receivables and my payables. Assume those are the same, right? Then we can start with income and kind of back out what is it that we got to refill our inventory to, because that's our biggest cost, right? That doesn't get captured on the income statement, gets captured on the balance sheet. So we need to understand the cash flow impact of that. So once we know cash flow, we can then apply a risk formula to that to get back to what we call a discounted cash flow. One of the things that's interesting that's happened with the interest rates is the first factor of risk is the risk-free rate. The risk-free rate is the one that the government charges banks to borrow at, or the treasury rates, right? And so the treasury rates, when they were zero, that was where we started our risk rate, right? So the risk-free rate, even at zero, was like 1.29% or something like that. That was what the banks wind up getting. And so we would start with a 1.29% value, add on risk from there. If all the risk was the same, a dealer 2 months ago, that 1.29 number that we started with was a 5.4 number, because the way interest rates have changed. So we start with 5.4, added risk on from there. In mid-September, the government took 0.5% off. So that 5.4% came 4.9%. So even right now, we start with 4.9%. They're out of all the risk. And so there's once we know what our total risk is, then we know, are we generating income above or below what our total risk is, and an income generated above or below that, or specifically above that would be goodwill. So most of you guys, the terms you talk about is book value plus goodwill. And so that's the combination of what most dealerships trade on. We got to understand the goodwill, which is coming from a discounted cash flow model, not an EBITDA multiple. And I think that's an important one to understand.
And Mark, one real quick thing just on that approach is that, again, if you guys are going to proceed with evaluation, is finding somebody that actually understands kind of that dealership and ag market. Because one of the things we see is, in a down year, we're just not going to base it on 1 year. You want to try to capture that full life cycle of a dealership. And I know when we go through some of these approaches, it's like, well, I'm going to be going up and up and up for the next 10 years. It's like, okay, we know the ag cycle long enough to where we know that's not true. There's going to be some down years in there. And just like this year, if we weren't planning for that, this valuations, would just tank. But, we should at least get that, 6 to 7 year range of kind of what does that look like? A backward look, which is always good, but also that forward look as well. And again, just having to make sure we capture all those little elements is very important, especially to a dealership valuation.
Right.
Because, we do valuations for other industries and they're a lot more simple. It is a product of, hey, maybe it is the last couple of years of EBITDA, take it from there. But dealerships a little bit more specific on making sure you're capturing that full life cycle of.
Yep. And not only that, but dealership, that word means a lot different when you're talking about an equipment dealership versus like a car dealership. And so a lot of the big valuation companies in the country, they do a lot of car dealers and that's fine as long as they also do some equipment dealers. But if they're only used to kind of doing car dealerships, one of the biggest differences between a car dealer and equipment dealer is the notion of being a franchisor versus a distributor. You guys are, they're in an equipment manufacturer. I don't think really out there that believes in the franchise model. It's more of we are the supplier, you are the distributor. We're going to give you are going to buy equipment from us and then resell it to somebody else. And as such, at some point we might ask you to sell more, and you're kind of a captured market for us. We're going to send you equipment. We expect you to buy it when we ask you to, and try to get that sold. And that is a big difference. I know some of the deals that I've seen fall apart in the last couple of years have been guys that have come from the car dealership market that are trying to enter the equipment dealership market because the cycle might be such that they think I can make more money in the equipment dealership market. And the first thing they look at me and they think I'm crazy is when I tell them you got to have this much inventory, and they're like, no, I'll just talk the manufacturer down. I won't carry that much inventory. I don't need that much. And it blows a deal up almost every time. And so that's an important one to understand if you're kind of in that negotiation stage of does the person that came up with your valuation understand the nuances of the equipment dealership market? The other, so why have a valuation every year? I'm not necessarily going to give an estate tax change every year. We might have one again next year, though. We could very well, I would guess. We know this: the current president isn't going to be the next president, right? And so the next president is going to be somebody different, and tax is one of the things that the presidents really like to hang their hat on. And the one that's the most volatile a lot of times is estate taxes. We've got one candidate out there that would like to keep the estate taxes the way they are prior to them expiring at the end of next year and have a big number that we can give away. The other candidate would like to see that number go down. And so we know there's going to be some changes in estate taxes. Even if Congress can't agree on anything, we know that number is going to change. Well, if you didn't get your dealership given away or substantially given away by the end of 25 and that number changes, we need to understand it's going to be a very short time between now and then that we're going to need to understand your valuation so we do something about it. But that isn't the only reason why, right? That when growth happens like it has the last couple of years, your capital might not have kept up. And one of the biggest conversations we're having with dealerships right now is their equity computations and why their equity has slid 5 and 10%. And it's because their inventory has gone up in value. They're selling a whole lot more inventory. Their expenses have gone up, and all that kind of stuff. And that growth is expensive. And they might not have been ready for that capital wise. Well, we can understand growth as it applies to valuation when we're talking about the entire valuation of the company a lot better than we can understand it when we're just simply focused on net income and the tax results of that and that kind of thing. Cash flow. Capital is one thing, cash flow is another. You might be well capitalized, but your cash flow might have one-time hits in there or multiple time hits on there where you're going through succession planning. You got to buy some owners out. You might be going through a period of time like we just did. If you think about their balance sheets at the end of 2022 when you were out of inventory versus the end of 2023, what your inventory looked like then, you might have burned all of your cash plus some because your inventory doubled and tripled in carrying costs during that time frame. And then risk, certainly a dealership today at the size it is, with interest rates where they're at and commodity prices the way they've been going, is much more at risk than a dealer was in 2019. And not only are they more at risk, they've got more at risk. And so understanding what your valuation is with those levers is kind of very important to understand that. Ryan, maybe both of us can weigh in on this. I kind of list this as maybe a side benefit of one of my I'm a geeky accountant, right? So one of my favorite parts of evaluation is one of the reports that it prints out called a Q of E. If you haven't heard of a Q of E report, it means quality of earnings. It's not quite an audit like we typically do for our dealers at year end, but it's something a little bit different. What's kind of your take on quality of earnings?
Yeah, so I think a lot of our dealers do get audits, and again, it's at a very high level approach on a lot of those things. The quality of earnings, really, we're diving into a lot more specific on, is it sustainable? One dealer, if they got a whole bunch of mud deals going on, that may not be as sustainable as maybe the same amount of revenue, but more consistent. So there is risk there when we really dive into it a lot of times there. And we even look at some of the expenses and stuff like that in terms of, do we have a lot of shareholder expenses in the business? But as our goal, normally, if we're planning for this right, if we know that there's going to be a sale or merger coming up, we want to clean this up as much as possible. The worst thing we can do is get into that merger discussion. We're trying to pick apart all these expenses, and that gives the other party anyway a little bit of worry because they don't know what else may be buried into some of that. So the more we can kind of clean that up going into it, the better. And a lot of this Q of E stuff, we'll dive into a lot of those approaches.
Yeah. It's, I went through a merger with a couple of dealers a couple of years ago. And that exact thing happened. When you looked at the raw numbers of even their audit, so an audit is just saying we looked at their controls. We looked at their financials. Everything they say they have is there. The controls that they have in place are there and they're adequate. And we might have, even with that, there could still be shareholder expenses. There could be some weird stuff that happens in there from year to year. A big one that's not necessarily a dealer's fault, and it was a good thing. PPP was a great example. 2021, if you would have looked at a dealer and bought one based on their net income or their cash flow, you'd say, holy cow, they're killing it. And if you didn't look close enough and see, oh, but they had a PPP loan in there that got forgiven and it was $8 million and their profit was $9 million. If I back that out, it was a completely different dealer than if they didn't have the PPP. But, the example I was going to give was we had two dealers, the raw numbers, the raw audited numbers would have said that the deal was essentially 40-60. Right. But when we drilled down into the quality of earnings stuff and we took out the fact that, this one was a C Corp and this one was an S Corp. And so our tax distributions in one company is an expense, in another company, it's a distribution. Because one was a C Corp versus an S Corp, we do things different with salaries. And instead of paying somebody, in a C Corp, we might pay somebody $300,000. It's worth $200,000 because they're an owner, because we don't want that distribution to be taxed high. On an S Corp, we do the opposite. Somebody that's worth $300,000, we might only pay him $50,000 because we'd rather have that distribution go through and not have to pay the self-employment tax. So when you start making adjustments like that, this particular dealer had enough of that going on that the 40-60 relationship inverted, and the 40% dealership was clean. The 60% dealership was not clean. By the time we made the adjustments, it was 60-40, not 40-60. And you can imagine, as the 40% guy, he's like, oh, so what else can't I trust? It's not that there wasn't anything that was on there that was shady or illegal or fraudulent or anything like that, but the number changed so much, it made him question the deal. And the 60% owner as well, he's like, wait a minute, I was 60%. I knew I was 60%. And now you're telling me I'm 40%. Deal's off. I don't want to do this deal. That took a lot of getting back to the table to make sure everybody even understood what was there all along, just not defined. So to Ryan's point, if we know we've got a valuation event coming up, one of the things that we would coach a dealer into doing is get rid of as many of those quality of earnings adjustments as possible. If we know our salaries aren't right, let's make them right. In today's world, the 21% versus the 29.77 effective rate, once we take the 199 deductions out, our S Corp rates and our C Corp rates have gotten a little more equalized. So let's just fix that. Same with rent. If we know we've got we've got our rent company over here. We own the property over here and we're taking money out of one pocket and putting in another. If it's fair market value, then we don't have to make any adjustments. When we go to sell the company or when we go to bring in another investor, we can make an investor here and an investor here, and we don't have to worry about truing anything up. All that stuff just makes the transaction and the valuation a lot cleaner. So, transaction aside, there's some other reasons why valuation becomes important. And Ryan, chime in on here. We didn't necessarily discuss how we're going to split this slide up, so we'll be a little fluid with it. I know as an investor, if I take my accountant hat off a second and I look at my personal life and say, as an investor, I want to understand the stuff I've invested in. How does the PE ratio or the price to earnings ratio or the price to book ratio, how does that compare from one investment to another? Because if I'm looking at one that's got a PE ratio of 40 and another one that's got a PE ratio of 10, I'm going to feel a whole lot more confident of the one that's got 10. And so, when we just look at book value, we don't know that. When we actually set a value on the company, we can do a PE ratio just like we would an Apple stock, right? Because now we know the value is this. We know what how many shares there are. We can get down to what their true earnings per share are, know what our price to earnings ratio is. And we can not only compare ourselves to anybody in the market, we can compare ourselves to the Dow Jones. We can really understand the health of our organization from companies much bigger than us and learn from the things that they learn. Similar to price to book, one of the things that I know that we look at hard in a valuation strategy is when we put a whole lot of growth on a company and say, oh yeah, we only made $10 million this year, but when we look 5 years out, we're going to make $50 million. Okay. Yeah. Pipes and, dreams, right? Well, part of that, one of the things that we can look at is this PEG ratio, which is how much of our price and that future price that's driven back is just come from growth. And when that number is over 100, in other words, we're going to be 100% better than we're going to be now. That starts to make me wonder how good that valuation is versus how aggressive we were just at, on a forecasting. What are some of the other things maybe on that other side, Ryan, maybe talk about the balance sheet ratios? Yeah,
just overall, it's even in the valuation ratios. One thing is that, as a shareholder, knowing what your value is, and we do have, if we keep asking generation to generation, we have some shareholders that maybe they do want to go do something else or use that money, and knowing, okay, I'm not getting much return. I could go take the same money from my sale, go invest it and get a 10% return. Right now, I'm only getting a 4 to 5% return in the dealership. Again, don't really run into that a lot lately, but
might this year.
Might this year. But at the same time, we need to think about, okay, what does that mean versus our valuation? Not just net income, can be manipulated EBITDA, a little bit of the same way. So knowing what that is per your valuation helps you make decisions in terms of, maybe it is the right time to sell. Maybe we hit when the market's hot. Yeah, but just knowing it and be able to react to that is pretty critical for our dealers.
One of the ones that's on here that the group might not have seen before because it's a bank number and it doesn't necessarily apply to you, but I threw it on there because if you know your value, you could kind of calculate this as well. And that's that capital adequacy ratio. And that's one that when the government is auditing a bank, they look at the bank to see, do they have enough capital to be as big as they've gotten? And that's a fair question to ask dealerships right now. Is your capital sufficient to cover you as big as you've gotten? That was the conversation Ryan and I literally had with the dealer that we have been working with here the last couple of days. They, like many of you, have doubled in size over the last 5 years. They brought in some new owners. Their inventory in 22 to 24 has almost tripled in size. And all of a sudden the question can be asked, is our capital sufficient to be this big? Or do we need to look and do something different? Or do we need to purposefully get smaller? Something a dealership usually doesn't ask itself, but it's a healthy question to ask if your capital is not good. And you don't know the answer to that unless you know what the real value of your business is. So that's why we threw that one in there.
And yeah, just to kind of come back on one of the other ones, that free cash flow number, I think you alluded to it a little bit too. It's we're making a lot of money, but maybe our inventory levels have just been depleted. So it's not sustainable there. And that's one we really look at is inventory levels. And again, we're accountants too, so we like to dive into that type of thing. But what is the right, used inventory, new inventory mix for a company going forward? Because it is a lot different. And when we look at a sales mix, a lot different now than it was 5 years ago. Yeah. And so or we have to spend a lot of money on our inventory to kind of maintain those balance to get the same type of return on equity, return on investment that we're used to. Because the bigger you get, the harder it is to get that same return on equity.
And October is always a good year for you guys to look at that. That's why we're having, obviously you can look at the calendar and you probably know exactly what we were meeting with a dealer we were meeting with. October 31st is right around the corner. Most manufacturers year in, and you guys are looking at that market share and that elusive chase that you do every year. And one of the things to be extremely important about is I think there's probably not very many dealers around that wouldn't admit that our sales for next year might not be as high as they were in 23 and 24. We might be looking at a reduction. And so then if you look at inventory values like we did with the dealership today, we're approaching, as we chase that market share number, we're approaching a whole year of inventory on the lot as we sit here right now, if our turn ratios are normal. And you don't have anything else to plan for other than those normal turn ratios, right? So, and normally I turn my inventory 2.2 times or 3.1 times. If all of a sudden 3.1 times of what you have now is 4 times the sales that you would normally have, you don't have, you've got inventory way beyond where you should be, and you need to start looking at that number. So, I'm sure you guys are looking at that number, and probably that's more important to you today, top of mind than the valuation. But as you get that number right size, we'd ask you to kind of come back and look at valuations too. So, specifically about how do you use valuation then to manage a dealership? Part of it is some of the questions that you guys should be asking yourself is how far away are our principals from a transition? In other words, retirement or death if they've stayed around too long. How long before we've got to do something? If your buy-sell agreement doesn't say specifically when that needs to be, we generally know that somebody's going to want to start slowing down at 62, 65, or 70, right? And so how far away from that are they? The other question you might ask yourself is, based on the way we've grown or not grown over the last few years, based on what our valuation has done the last 5 years, would I still buy it today? It's a real question to ask, particularly when you're going through succession planning. It's one thing, as you sit around with the first generation of guys saying, oh man, it's so awesome. We grew this thing from being worth 20 million to being worth $30 million. Never mind the fact that the last year and a half, we've kind of slipped a little bit. It's worth $30 million. So generation 2, we're ready for you to buy us out at $30 million. They might be looking at that a little bit differently than you. They're looking at that last year and a half a lot harder than you are. And so you need to ask the same question. Would I still buy my business at that value today? And then finally, how do I measure success? Is it all net income? Is it finding somebody to buy me out at retirement? Is make sure that I get, because the value could change if part of success to you is that I make sure that this guy gets to run the business or my family gets to continue the business. Then the valuation changes a lot, right? Because you're more concerned about legacy than you are value right now. And so those are questions, no wrong answer to, that you need to understand as you look at valuation. But again, you got to know what the real value is before you start understanding what appropriate discounts to use are, or what kind of, not the discounts that Ryan talked about earlier with the formal ones, but the ones of, if I'm going to sell my business to Ryan and I like Ryan, so I want to just, I want to give him $1 million. I don't, by the way, but if I had $1 million, you might be one of the people I gave it to. But those are the kind of things you need to understand. You don't understand those until you know real valuation. The other things that business owners, understand better when they know the value versus the book value is that volatility and how it determines when I ought to pivot. Because there are definite times in there when you can see a change coming. The interest rate is one of those. If we know right now the interest rate, the government has said, hey, interest rate isn't going to be here forever. By the end of 25, we want it to be down 2 or 3%, which means we are going to get a recovery. So we should get some bounce back in our valuation. We haven't heard anything from the USDA that makes us feel anything better about corn prices, though. So we don't know what that looks like. But when we do know that there's a pivot coming, that might be a good time to time an exit, right? That we got a valuation that we might be approaching the hump here. Let's get out, or we might be approaching the worst of the worst. And so this would be a good time for somebody to buy in now versus letting him buy in, 2 years from now when we've completely rebounded. And then just again, I like the ability for me to take my business and compare it to other businesses. And once I've done things like quality of earnings, once I've done things like understanding my PE ratio, then I can compare my business to your business, even if our businesses aren't necessarily even in the same industry or in the same geographic region or wherever. Business is still business at that point, and understanding value is important. So that with that, Ryan, how about for some shareholder stuff?
Yeah, so just from the shareholder standpoint, I think if I had any takeaways right for this webinar, it would be one, let's just start the conversation. That's kind of the first step. People are like, well, I'm not sure I'm ready. I'm not sure what we need to do. One, let's just start the conversation with your ownership group, with your key management, and just seeing, okay, where do we start? Let's get that baseline going, obtain that valuation, and then from there we can kind of start to craft. Look into your ownership group. What are their ages? What do we need to put in a buy sell? Things like that. Because even the ones we've been working on, we have 35-year-old owners. Okay, we're still going to plan for the retirement because we have to have that end in mind. And so we're making sure we're thinking of all those things from a valuation perspective. And even then, some of the strategies that we've been implementing, if we have an ownership succession to the next generation, maybe we do want to keep a lot more capital in the business than we're used to. Maybe that 30% goes up to 40%, so we can leave them in a better position kind of going forward. And so there's some of those things that we kind of start to think about. Funding life insurance policies on key persons. That's a big one just from that next generation isn't going to have, $5 million right off the bat just to buy me out. In the event of, a death or something like that we're not planning on, we definitely want to make sure we have those in place for sure. And then every single shareholder we walk through, it's trusts, wills, that whole estate process. We'll bring in attorneys to think through some of that stuff. But it's a risk for your shareholders not to have that in place, because then it may go to, an owner that you don't want to be partners with potentially. And so
The point where I think it's often it should be if the shareholder doesn't want to do it, dealership might even need to force it. Just to make, if you don't have an estate plan and you've left it willy nilly, I don't, and you have 6 kids. I'm sorry, but I'm not going to be in business with all 6 of your kids. That's not what I intended. You need to get your affairs in order if you're going to be an owner of this business. The life insurance, that's an interesting one because the life insurance has also gotten more expensive as everything else has. So even you might say to yourself, well, I can't cover all this with life insurance anyway. The value's gotten too big, but you can cover some of it. So for instance, you might have covered your CEO 3 years ago with $1 million life insurance policy when your company was worth $5 million. If your company is worth $10 million, I'm not suggesting you go out and you spend the money to get the whole $10 million, but you might get 2 or 3 million, right? And kind of understand what that is, because when it comes to life insurance, you play that long game, right? Of saying you get 10 and 15 and 20-year term policies that don't change in price over that course of time. So if I lock it in now, then a $3 million policy might not be as expensive as I thought it would. It will be really expensive if I wait until my shareholders are 50 or 55. If I can get them before that age, then I can lock in a long-term price.
Yeah, and one thing that's kind of interesting just in terms of that is, and we look at it a lot of valuations, it's what is your key management structure? So who are those key people? Normally we think, okay, the owners are in key management positions, but the more dealers we work with, that's not necessarily the case. And so this CEO is very, very critical to the growth. What happens if he leaves? What happens if something happens to him? That could impact your valuation if you don't have that right succession in place. If this, then we're going to pivot to this.
Yeah, because in addition to the valuation, if you haven't looked at your buy-sell agreements in a while, they have gotten way more sophisticated in the last 10 years. Because what your buy-sell agreement needs to focus on is how does the company survive this transaction? Whether this transaction is a retirement or a death, we can still plan for it, right? It's harder to plan for a death, but you can plan for a death through life insurance and through succession planning to make sure at least know who's going to own it and what that payment looks like. You can plan for a death by saying, hey, Mark's dead. We got to buy his wife out, right? But we don't have to buy her out with 100% cash right now. Our buy-sell agreement was crafted to say we would have paid him out over 10 years, so we're going to pay his wife out over 10 years. And so we can kind of, even in those strategies, we can plan for that. that. I usually like to build several things into buy sell agreements that we talk about. It's making sure we know how we're going to deal with that significant cash flow outage. So if you're going to retire, we want a certain amount of notice. We want to make sure you're over a certain age, and you've given us notice so we can prepare for it. If you're divorced, we want to make sure that we're clear that just because you've got a financial problem where you got to come up with half the value of your stuff to split with your ex. That's not our problem. That's your problem. So we might even have to build in a discount in there to make sure that doesn't happen. So just your buy sell agreement needs to get a lot more sophisticated than if you've had one in place for 25 years and haven't looked at it yet. So in addition to value, dust that thing off and see if there's anything else we ought to be looking at. So with that, I think, Kim, we're pretty close to the end of time. I don't know if we've got any questions or not on here yet. But if we do, we're certainly prepared to answer those.
None have come through, but feel free to submit any. We have a few minutes. I did have one. And what you were just saying about, so if someone died, having it in there so that you pay their spouse over 10 years, does that continue to translate? So like, if that spouse unfortunately died within that 10 years, does that just transfer down to
it depends on how it's written, but that would be definitely the intent is that we're sorry you died, right? And we're going to make sure we're going to do everything in our power to make sure that you get your heirs get 100% of what was coming to you. But 100% of what it was coming to you would have looked like this when you were alive. So it's going to look just like that when you're dead. It's going to, but it's going to go to who your heirs are. Now, there's no ownership with that. What I'm talking about at that point is we're gonna buy the owner out when he dies or when she dies, but we're gonna do it over time. So there's no ownership right anymore, but there's a promissory note that's paid over time.
Okay. And then is there with this annual valuation that dealers should be doing, is there a certain time of year that is best to be like? Is it do it while you're doing your taxes? Is it some other time of the year that makes
what we go ahead, Ryan.
I think the best approach we've used, just because throughout the year there may be some kind of wonky numbers there. So it seems like most our clients either have an audit or reviewed financial statement. So normally we like to do it kind of right after there, so we know we're using audited third-party reviewed numbers.
Good cutoffs. There isn't something that got missed.
So that way there's no question of, is this actually accurate information? So if you kind of have that third-party numbers you're basing everything off of, that's normally the good cutoff, at least in terms of the financials. And then you don't want to wait too far into the year to where it's November, December, and you're looking at the prior year. So normally that March, April timeframe feels like a good time to kind of have that conversation.
Yeah. And on top of that, what we usually suggest is that buy-sell agreement isn't we get the value from the valuation team. It might be, but it's also here's the formula. So again, not only does the business prepare for stuff, but so does the shareholder. The shareholder can kind of understand these are the things that are going to make value go up and down. And so we can kind of plan for that on both sides of the transaction. So nobody gets caught off guard because, especially with mergers and acquisitions, oftentimes I see a guy comes in, he owns 100% of the business. If the other guy owned 100%, now they both own 50, right? And so the last majority decision he made was to come together. He didn't even control how the business is valued anymore, unless the buy-sell agreement kind of says, here's the formula that we're going to use for valuing the company. And we're going to have our auditor look over it, or we're going to have our attorney look over it, give their blessing or whatever to make sure we did it right. But we got a formula so that there's no question this is how we're going to value the company.
With that, I think we'll wrap up. If you have any questions for either Ryan or Mark that we didn't get to, their emails are up on the screen. You can also reach out to us and we can pass it along to them as well to answer. Like always, we've recorded this webinar, so it'll be available on the Farm Equipment website in the event you want to go back and review it. Keep a watch on your email and the Farm Equipment newsletter for more information on when that's available. On behalf of Mark, Ryan, the Pinion team, and the Farm Equipment staff, thanks for joining us for today's webinar. Feel free to reach out to me if there's any topics you'd like to see us cover in the future. And thanks again, everyone, and enjoy the rest of your day.